Hello, welcome back to the next of our full course lectures. This lecture continues our group workings and we're looking here at the fair value of the net assets. So remember that the net assets are what we're acquiring in the subsidiary. So we're acquiring the net assets of the subsidiary, but remember that IFRS 3 says that we need to acquire those at fair value. So if they're not at fair value, we'll need to adjust them. So when it comes to these net assets, what are we talking about? Well, as I said, when we're acquiring a subsidiary, what we will need to do is we'll need to review the assets and liabilities that we're acquiring. So it may be that the assets and liabilities that the subsidiary has in their individual accounts aren't at fair value. For example, they may be at historic cost if it was property, plant and equipment. So if they are at historic cost, they've been depreciated over a number of years, they may well not be at fair value in their accounts. So if they are not at fair value, we will need to adjust the assets that we have acquired. So this is usually land, property or plant. And do remember that if we adjust the asset value for our group accounts, well then we'll need to adjust depreciation as well, because we'll have some extra depreciation on the new value. So we're taking the individual entities' accounts, we're looking at the value of the assets that they have in there, and if they're not at fair value, we will need to adjust them in our group accounts. So how do we go about doing that? Well, first of all, we're going to do it in our working two. So in our working two, we're going to add in any fair value adjustments. We'll do this both at acquisition and at the year end, unless they've already adjusted for it by the year end. So we add the fair value adjustment. So in our working two, we have our shares, our reserves at the acquisition date and at the reporting date. We'll now have another line below that that says fair value adjustment. And that will be the difference between what the asset is in the individual entity accounts at and what the fair value we have assessed is at. Because we'll need to increase the value of the asset by that amount to get it up to fair value. So the fair value adjustment will be adjusting at acquisition and at year end in working two. Now the other side of that we'll need to do is additional depreciation. Now that will only be at the year end because the period of time needs to pass until the depreciation happens. So we won't adjust for depreciation at acquisition because we'll need some time to pass for the asset to depreciate. So at the end of the year, we'll have some extra depreciation on that asset. So we'll need to subtract that out from our working two for the assets at the reporting date. So once we've done that, then on the statement of financial position, when we finish off our question, we'll need to add the fair value adjustment to the value of our assets. So we'll need to increase the value of our assets on the face of our statement of financial position so that they're coming up to fair value. And we'll need to subtract any depreciation from the asset to allow for that extra value, because that will create extra depreciation. So in our working two, in our column at the acquisition date and at the reporting date, we will need to add in any fair value adjustment to bring the assets up to fair value. We'll then at the reporting date depreciate any extra. So we'll take that extra depreciation out in the column at the reporting date in working two. On the statement of financial position, when we come to complete our question, when we're adding across the assets, we'll add in the fair value adjustment. And we'll also subtract out any additional depreciation. So let's bring this all together in an illustration that covers all five of our workings, including a fair value adjustment. So illustration 10, let's work through it together to make sure that we can do this correctly. Our first working for a group statement of financial position is always the group structure. So in illustration 10, we have Jimmy buying Gent. So Jimmy is the parent. He's buying 80% of Gent. So Jimmy is buying 80% of Gent. The date that he's acquiring it is 1 year ago. So he's acquired it 1 year ago. Parent share then is 80%, as we've said. The non-controlling interest will be the rest to make up the 100%, and that's 20. So add that up just to be sure, 100%, so that's our group structure. Our second working is our equity table to work out our net assets. So as usual, we'll start with our share capital. No change between acquisition and the year end, it's 250 taken from the question. Accumulated profits, we're told that at acquisition our accumulated profits were 150. So Gent had accumulated profits of 150 at acquisition. At the year end that had gone up to 350. Now up to this point that's usually all we would have, but now we have this fair value adjustment. So we're told that plant has been valued and it's 100 greater than the book value. So we need a fair value adjustment of 100. So we put that in at acquisition because that's when we did the fair value assessment. We also need to put it in at the year end because it's still going to be at a greater value at the year end as well. So we put the fair value in both at acquisition and at the year end. Don't forget as well though, we're going to have additional depreciation. We're told that the piece of plant has a useful life remaining of 5 years. So we're going to have depreciation for 1 year because this happened 1 year ago. The additional depreciation for 1 year will be the 100 divided by the 5 years is 20. So we don't put that in at acquisition because there was no additional depreciation then. We put it in at the year end. The additional depreciation, 100 of a total over 5 years gives us 20 of depreciation. So adding those up, at acquisition we have 500 of net assets and at the year end we have 680. The difference between those two will be the accumulated profits in the year, and that's going to be 180. Working 3 is always our goodwill, and we are going to use the fair value of the non-controlling interest to calculate gross goodwill in this example. So we're going to use our big working, and that starts off with the cost of the parent's investment. Well, we can see from the individual statement of financial position that the cost of the parent's investment was 800. So Jimmy paid 800 for Gent. The parent's percentage of net assets at acquisition, so that comes from working 2. The net assets at acquisition were 500. The parent's percentage is 80%. So 500 times 80% gives us 400. So we know then that the goodwill attributable to the parent is 400. On then to the non-controlling interest. We're actually told that the fair value of the non-controlling interest at acquisition is 160. And often the question will tell you that. So the fair value of the non-controlling interest at acquisition was 160. We need to subtract the non-controlling interest percentage of the net assets at acquisition. So the rest of the 500 of net assets effectively. So we had 500 from working 2, non-controlling interest of 20%. So 500 times 20% gives us 100. That gives us the goodwill attributable to the non-controlling interest of 60. Adding those both together gives us gross goodwill on acquisition of 460, and that's the amount that will go to the statement of financial position. Working 4 is our non-controlling interest, and as usual we'll take the non-controlling interest percentage of the subsidiary's net assets at the year end. So again, coming from working 2, looking at the net assets at the year end. Net assets at the year end were 680. Subsidiaries non-controlling interest is 20%. So 680 times 20% gives us 136. We then need to add in our goodwill attributable to the non-controlling interest, and we calculated that in working 3 and it was 60. Adding those both together gives us a non-controlling interest of 196. Our last working 5, is always our group accumulated profits. So we always start off with the parent's accumulated profits. Always do that first. So parent's accumulated profits from the question is 500, looking at the statement of financial position given to us. We then need to add in the parent's percentage of the subsidiary's post-acquisition profits. So we work that out from working 2. Remember, we have 500 of net assets at the acquisition date. We have 680 of profits at the year end. So in between the two is 180. So we've 180 of post-acquisition profits times the 80% of the parent share, and that gives us 144. So adding those both together gives us group accumulated profits of 644. We now have all of the information that we need to complete the statement of financial position for Jimmy Group. Remember, first step, as per usual, we always put in an extra line for goodwill. Our goodwill comes from working 3. It's our gross goodwill that we put in here, and it's 460. Remember, the investment in Gent is cancelled out, so that's been cancelled out, so will be nil. The assets, we add those across, 700 plus 700, but we also need to add in our fair value adjustments. So our fair value adjustments were 100 for our plant. That was the value of plant had increased, but we need to subtract from that the additional depreciation. So we add in the extra value on plant, but we subtract out the depreciation. So that all adds across to 1480. Adding those up gives us 1940 for our total assets. Moving on down to our equity and liabilities. First of all, our ordinary shares. Well, we know that it is always the parent only, so it's 700. Accumulated profits, that comes from working 5, and we work that out to be 644. The non-controlling interest comes from working 4, and it adds up to 196. So our total equity is 1540. Our liabilities, 300 plus 100, adding them across gives us 400. Add that up gives us 1940 and balances our statement of financial position. Now that we've looked at fair value adjustments, just a couple of technical areas before we look at another illustration. First of all, for intangible assets, just be aware that these must be separated out on acquisition. So those must be separated out from goodwill and shown separately. The criteria for an intangible asset is set down in IAS 38, so it must be separable or contractual. It must have a reliable measure. So for example, a brand name or a database may well be examples of intangible assets. Now what we're saying is we need to separate those out and recognise an asset on consolidation. Now that's even if the asset isn't recognised in the subsidiary's individual accounts, and there's a reason for that, because under IAS 38 they can't show separately intangible assets that are internally generated, and we'll look at that in more detail in IAS 38 lectures. So how do we do this? Well, it would be a fair value adjustment. So for example, what we might have is we have a subsidiary that has an internally generated brand name. That's not recognised in their statement of financial position because under IAS 38 they wouldn't be allowed to do that. It's worth 20 million. Well, we would include that as a fair value adjustment on consolidation. So in our working 2, we would add in the 20 million as a fair value adjustment. So that's just a little technical area to bring to your attention. The last bit is don't forget that depreciation on the fair value adjustments. It's very crucial in this because there's extra marks for it. So there's always going to be additional depreciation on any fair value adjustments unless it's land. So remember that subsequent additional depreciation must be adjusted for, and check how many years it is since we acquired the subsidiary, because there may be several years depreciation to deal with. So let's look at another illustration, illustration 11 in your workbook. You may want to have a go at this one and then work through the answer with me. For illustration 11, we again need to start with our working 1, our group structure. So this time we have Devil buying Detail. They're buying 90%. So Devil is the parent, Detail is the subsidiary. The date they acquired them was 2 years ago. 2 years ago becomes important when you start to think about the depreciation on your fair value adjustment. So the parent's share is 90%. That leaves the non-controlling interest share at 10%. Again, add them up just to make sure you didn't make any silly mistakes at the start. Moving on to working 2, our equity table. We have first of all our share capital. We're told that our share capital, it hasn't changed, so it's 100 at each of the acquisition and at year end. The accumulated profits, we're told, are 250 at acquisition. And then we can see from the statement of financial position that at the year end they're 500. We now need to make an adjustment for the fair value. We're told in our question in the table at the top that the fair value adjustment is 100. So again, we need to make that at acquisition and at the year end. So we've made that adjustment at acquisition and at the year end. However, we're also told that there is depreciation. It's got a remaining useful life of 4 years, and we have 2 years since we acquired this business. So we need additional depreciation for both of those 2 years, and that will be 25 for 1 year, 100 divided by 4, so 50 for 2 years. So 25 depreciation for each year, 2 years is 50 in total, and that goes in at the year end. So additional depreciation for 2 years of 50. So that's why it's important to make sure that you know on what date the acquisition took place, how long ago it was, and make sure if it's more than 1 year, you put in enough additional depreciation. So the total net assets at acquisition were 450. At the year end, they were 650. The difference in between will be the post-acquisition profits, and that will be 200 in this case. Working 3 is our goodwill as usual. We're told to use the proportionate method, so we don't need to calculate gross goodwill. So using the proportionate method, we can take the cost of the parent's investment from the statement of financial position, and that was 1,000. We simply need to subtract the parent's share of the net assets at acquisition, so take that from working 2. Working 2, net assets at acquisition were 450, parent share 90% gives us 405. So that gives us total goodwill of 595. We're not calculating gross goodwill because we're told to use the proportionate method. Working 4 is our non-controlling interest. So we're going to take the non-controlling interest percentage of the subsidiary's net assets at the year end from working 2. The net assets at the year end were 650. The non-controlling interest percentage is 10%. So multiplying those together, we get 65. We've no goodwill attributable to the non-controlling interest in this question because we're using the proportionate method. We can now move on to finish our statement of financial position for Devil Group. So the first step, as usual, is to add in our goodwill. The goodwill comes from working 3 and we worked it out at 595. Adding across our assets, we get 600 plus 800, but don't forget to add in the fair value adjustment and subtract the depreciation. So remember, that's where the debit to the credit on our equity table is. So we have a total there of 1,450. Adding those together gives us total assets of 2045. So moving on then to the equity and liabilities. We have ordinary shares of the parent only, always 650. Accumulated profits come from working 5 and we calculated those as 430. The non-controlling interest was coming from working 4 and we had 65. So adding those up gives us total equity of 1145. Adding across the liabilities of 700 plus 200 gives us 900. Adding up our total equity and liabilities gives us 2045, and thus balancing our statement of financial position. The last thing I want to mention in this session is revision of fair values. So this is where there may be a provisional estimate of the fair value of the different assets. So if we have a provisional estimate, put in for our fair value adjustments, well, once we get the new information, we may find that that provisional estimate was inaccurate. So there is a rule on this. The rule is that if that information is provided within 12 months of the statement of financial position date, well then we'll remeasure goodwill. So if we find out what the true fair value was within 12 months, we'll remeasure goodwill. If it takes more than 12 months to get that information, well then we'll adjust that in the income statement. So rather than remeasuring goodwill, we'll put that any adjustment through the income statement and remeasure the value of the asset to the fair value based on the new information. So that's just a little note on some additional information. If you've got a provisional estimate of fair values, you subsequently get new information that says that the fair value that you used was incorrect. If you got that information within 12 months of the statement of financial position date, you remeasure the goodwill computation. If it takes longer than that, if it's more than 12 months, well then you'll remeasure the asset value and take that adjustment to the income statement. So that was our session on the fair value of net assets. Make sure you understand everything in this. Make sure you're able to do all of the illustrations, because as per usual, this is now going to be built upon in subsequent lectures.